Gold is trading at $4,600 per ounce today. It is sitting within striking distance of the all-time highs it set before the war shock hit the precious metals complex in late January. Despite everything that has happened over the past 60 days, despite the geopolitical noise, the Fed uncertainty, the margin calls, and the correction that wiped tens of billions of dollars from commodity markets, gold has held its ground, it has healed, it is resilient, and that resilience is sending a message to every serious investor who is watching. Silver is at $73, and it has not yet answered that message. That divergence, that gap between what gold is communicating and what silver has priced in, is the most important signal in the precious metals market right now, and understanding why it exists, how long it typically persists, and what happens when it finally closes. Is the difference between making a reactionary decision based on recent price action and making a calculated decision based on the underlying mechanics of how these two metals have always related to one another? Let me give you the framework first, because without it, the numbers that follow will not carry their full weight. There is a ratio that precious metals traders have used for more than a century to understand the relative value between gold and silver at any given moment in time. It is called the gold to silver ratio, and it is calculated by dividing the current price of gold by the current price of silver. The resulting number tells you how many ounces of silver it takes to purchase a single ounce of gold. When gold is at $4,600 and silver is at $73, that ratio is approximately 63:1. It takes 63 ounces of silver to equal the value of 1 ounce of gold. That number matters more right now than it has at almost any point in the past 3 years, and I want to explain precisely why. In April of 2025, the gold to silver ratio reached 100:1. That extreme reading was a historic anomaly. It meant that silver had become so cheap relative to gold that a single ounce of the yellow metal could purchase 100 ounces of the white one. In the entire recorded history of this ratio, such extremes have appeared only a handful of times, and each of them preceded a violent and sustained outperformance by silver, every single time without exception. The ratio crossed 100 in March of 2020. During the pandemic panic, silver subsequently rose more than 100% in the following 12 months. It crossed 80 in 2016 and again in 2018. In both cases, silver staged recoveries that outpaced gold by a factor of 2 or more. When the ratio reached 100:1 in April of 2025, it was telegraphing one of the most obvious setups in modern commodity markets, and the market delivered exactly as history predicted. Silver surged 147% over the course of 2025, compressing the ratio all the way from 100 down to 50. By the time the metal peaked at $120 in late January of this year, investors who recognized that signal at the extreme generated returns that made virtually every other asset class look pedestrian by comparison. Now here is where the story becomes urgent for investors watching today, in early April of 2026. After compressing from 100 to 50 during silver's extraordinary run, the ratio has now expanded back to approximately 63, and most observers have interpreted that expansion as evidence that the silver bull market is either over or severely damaged. That interpretation is understandable on the surface, because silver did correct violently. It fell from $120 to $64 in a matter of weeks, a 47% drawdown that ranks among the sharpest corrections in modern commodity history. But the interpretation is wrong, and the historical data is unambiguous about why. When the gold to silver ratio compresses from a multi-decade extreme and then partially re-expands during a correction, it does not signal the end of the cycle. It signals the beginning of the second phase. The ratio's partial re-expansion reflects a temporary dislocation between the two metals, one in which gold reasserts its role as the primary safe haven during a period of acute uncertainty, while silver, with its higher volatility and larger speculative component, overshoots to the downside. This is a mechanical feature of how these two markets respond differently to forced liquidation events, when margin calls hit and levered positions need to be unwound. Silver falls further and faster than gold because the speculative positioning in silver is typically more levered and less institutionally anchored. Gold, by contrast, is held in much larger proportions by central banks, sovereign wealth funds, and long-term institutional investors who do not participate in the kind of forced selling that drives silver's acute corrections. The result is a temporary expansion of the ratio that creates a second window of opportunity for investors who understand the mechanics, and the historical evidence for what happens next in this pattern is remarkably consistent. Following every major ratio compression and partial re-expansion in the post-Bretton Woods era, silver has gone on to deliver another significant leg higher before the cycle ultimately exhausts itself, not in weeks but in months, and not by modest margins but by multiples that leave gold's contemporaneous performance in the dust. Right now, multiple major financial institutions are telling you the same thing the ratio is telling you, though they are using different language to say it. Citigroup raised its silver price forecast to $150 per ounce in January of this year when the metal was still near its highs. They have not abandoned that forecast. Their commodity team, led by Max Layton, described silver as behaving like what they called gold on steroids, a metal that moves in the same direction as gold but with dramatically amplified magnitude. Citigroup's reasoning was simple and structural: strong physical demand, a persistent supply deficit now entering its 6th consecutive year, and the compression mechanics of the gold to silver ratio all point toward continued outperformance. Deutsche Bank has published a year-end silver target of $100 per ounce for 2026. UBS expects silver to challenge $100 by the middle of the year. The LBMA consensus poll of professional metals analysts, which aggregates Forecasts from the most respected commodity desks in the world shows an average 2026 price expectation of $79.57 per ounce. Silver is at $73 today. Institutional consensus says it should be at almost $80 on average for the full year. That means the institutions that allocate capital for a living believe. Silver is currently trading below where it should be even in a conservative scenario. The supply side of this equation has not softened. The Silver Institute published its 2026 market outlook in February and confirmed that the global silver market will remain in deficit for the sixth consecutive year, with a projected shortfall of 67 million ounces. Total mine production is forecast to grow by just 1% to 820 million ounces, a rate of expansion that is structurally incapable of closing a demand gap that has now accumulated more than 800 million ounces of cumulative shortfall since 2021. The industrial demand that has driven this deficit, from solar photovoltaics, from electric vehicles, from artificial intelligence infrastructure, is not a trend that responds to short-term price movements. It is embedded in capital expenditure commitments made years ago by governments, utilities, and technology companies. Those commitments do not get cancelled because silver had a bad February. What is particularly compelling about the current setup is the dynamic between gold and silver on the demand side of the monetary equation. Gold has been supported through the entire correction by central bank purchasing, ETF inflows, and institutional allocation that reflects genuine concern about the long-term trajectory of the U.S. dollar and the sustainability of American fiscal policy. The U.S. national debt now exceeds $36 trillion, and the annual deficit is running at more than $1.5 trillion with no credible political path toward reduction. The Federal Reserve is caught between a slowing economy, where fourth quarter 2025 GDP came in at 0.7%, and persistent inflation driven by an oil shock that the central bank has no tool to cure. These are not temporary conditions. They are structural realities that have been building for years and that have caused gold to go from $1,800 per ounce in 2022 to $4,600 today. Gold is pricing in a debasement story, and that story has not changed because silver had a violent correction. Silver has simply not yet repriced to reflect what gold is already telling you. The gold-to-silver ratio at 63:1 is above the long-term historical average of 60-65, which means silver is sitting on the cheap side of its relationship with gold even after last year's extraordinary gains. The ratio has room to compress further, at a 50-1 ratio applied to a gold price of $4,600. Silver trades at $92, at a 47-1 ratio, which is where it traded briefly during the January peak. Silver is at approximately $98. The institutional targets of $90 to $100 are not aggressive fantasies. They are the mathematical output of applying historically normal ratio relationships to a gold price that the market has already accepted and institutionally anchored above $4,500. The near-term catalyst calendar adds another layer of urgency. The April CPI print, which arrives in the middle of this month, will be the first data release to capture the energy inflation from the Strait of Hormuz closure. Oil at $100 per barrel, even after recent ceasefire optimism provided a temporary pullback, has been running through the supply chain since early March. When CPI reflects that reality and Federal Reserve rate cut expectations are forced to reprice once again, the opportunity cost calculation for silver will shift. Every step lower in real interest rates is a step that expands silver's relative attractiveness compared to cash and bonds. The Fed, as the dot plot from March 18th confirmed, has locked its nominal rate in place while inflation rebuilds underneath it. That is the formula for negative real rates, and negative real rates are the environment where silver's monetary identity reactivates on top of its already running industrial demand. For the investor watching today, the message from the gold-silver ratio, from the institutional forecast consensus, from the supply deficit data, and from the macro calendar is coherent and directional. Gold has told you where the broader precious metals cycle is in its arc. It has held value through a violent correction in silver. It is trading within sight of its all-time highs as of this morning. It has not capitulated, it has not broken its structure, and every historical precedent in the modern era says that when gold holds and the ratio partially re-expands, silver's next move is larger than the move that preceded the correction. Silver at $73 has not yet answered what gold at $4,600 is already saying. That silence between the two metals is not uncertainty. It is the setup, and the history of every major precious metals cycle in the past 50 years says that silence eventually breaks, quickly and completely, in one direction.